Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, Scott, how are you? Welcome to another episode of the AWA Market Minute.
Yeah. Great to have a chance to chat today, and we're right here on the doorstep of summer, so kind of a fun way to kick off summer, right?
It is. Today is going to be an interesting day for me. Not only are we on the doorstep of summer, in a few hours, my oldest daughter is graduating from high school. And Scott, I know you've gone through this twice before. This is my first time going through this. I don't know how to emotionally prepare myself for this, and I'm not sure that you're the best person to go to and ask for advice on emotionally preparing myself for my child to graduate.
Yeah, I tend to be a little bit on the stoic side, although, some tears were shed with my daughter, certainly. So, yeah. No, and I know, I was going to say, I know part two of that, Paul, is you're going to be chaperoning a high school party till the wee hours of the night. So you've got a full day ahead of you.
I do. So I got roped into taking care of the pickleball tournament at the all-night party the high school will be putting on. So I'll be operating on low fuel tomorrow. So if anybody does see me tomorrow and my eyes are bloodshot, I promise it was not because I was out intentionally partying with the high school kids. It was I'm chaperoning this event, but we're looking forward to it. We're excited. And today is going to be a great market call, Scott. We do these every month. We love meeting with the clients and having conversations about topics that are relevant and timely and important. And as you and I kind of put our heads together this month and talked through, what we felt like would be a really good topic, one thing that kept kind of coming top of mind all this year has been cryptocurrency. It seems to be something that creates a lot of strong opinions, and almost everyone, investors love talking about it. And you hear people with lots of ideas on what it is and what whether it belongs in a portfolio or not. Some people think it's the future, and they'll go all in on this idea that like crypto is going to be something that is this massive opportunity that we all need to participate in. And others think it's a total farce and it's on a bubble, and it's something that you have to avoid like the plague. I think that about sums it up. So my question to you, Scott, as we dive into today's market call is, why do you think crypto dominates the conversation even after all the volatility that we've seen it go through?
Yeah, no, it's a great question, Paul. And I think there's a lot to unpack there. And maybe a good spot to start is kind of where things are at present. Maybe just giving our audience just a quick synopsis of kind of where things are, and also why some of the trends that we see today and that we've seen over the past 10 years have created an environment where there is an appetite for crypto. So that's probably a great spot to start.
Yeah, I think that's a good place. Let's jump in there.
Yeah, so we wanted to begin with kind of performance year to date. We're looking, the purple line is the S&P 500, so the market broadly, up about 8% so far this year. And then the kind of orangish line is the bond market. So it's down about 1.7%. And so this is highly unusual behavior, Paul. And we've talked about this previously, where we have a big major conflict in the Middle East, and typically the playbook is when we have war and conflict, stocks sell off and bonds are appreciate in value, and we've seen almost the opposite phenomenon. So stocks did take a dip with the kind of onset of the war, but since about April 1st, end of March, stocks have rallied pretty substantially.
And we saw that in our last market call. We talked about kind of some of the reasons why we've seen equity markets doing well in spite of some of the concerns we've seen, but there's more at play with the bonds, particularly why they're not performing well. And I think, we've talked about this, Scott, but inflation obviously has a big role to play here.
It does. It does. Yeah. So inflation, the most recent print we had came in at about 3.8%. So we're about 4% inflation. That's 2 percentage points higher than the Fed target. And that's been stubborn and it's been sticky. And so there's a variety of reasons why we have high inflation right now, but inflation is likely here to stay with us for some time. And so the high inflation has led to interest rates going up, and interest rates going up have an adverse effect on bonds. And I want to spend a little bit of time, Paul, on the bond market specifically. There's an old market adage that says, the stock market's smart, the bond market is smarter. And I think there's a lot to that. And I think what that intimates and what that suggests is bond markets can yield insights into markets and economy that just don't come from the stock market and the overall credit market. And in aggregate across sovereign debt, across the globe, is much bigger than the stock market. So there's a bigger data set there to look at. But what we've seen is since about March 1st, Paul, interest rates have gone up on the 10-year U.S. Treasury from about 4% all the way up to 4.6%. That's a pretty healthy spike in interest rates. It's not like record setting, but that's a pretty high spike. And in response to that, interest rates across the economy have risen. We've seen mortgage rates go up higher. And we've also seen bond prices take a hit. And I'd like to kind of educate our audience and speak to our audience a little bit about why the duration of the bond you hold matters. And when we talk about bond duration, we're talking about how far out the maturity is of the bond, how far out the interest payments are you're going to receive. And what we're looking at with this slide right here, Paul, is a long-dated U.S. bonds. So long-dated U.S. bonds, meaning 25 years out or greater. Those long-dated U.S. bonds have fallen almost 18% over, a 6 or 8 week period. That is a significant drop. And this isn't because they're low-quality debt. It's U.S. debt. This is the highest quality debt on planet Earth, and it's fallen like a rock. And that's because the duration is super long. If we go to the next
Scott,
slide.
Can I chime in on that real quick? So I think this is a topic that it's not as intuitive for the average investor, and maybe even like one layered in kind of conversation on like why the bond market might be a little more intelligent than the stock market. I wonder, this has never occurred to me before, Scott, but I wonder if more people with less information participate in the stock market. Right. It's kind of like the kind of thing that, your buddy at the water cooler talks about all the hot stocks he wants to go buy. And the bond market feels like, maybe a little more educated audience that wants to participate in that space. I wonder if that's why we're seeing more happening, from a sophisticated analysis perspective that is more telling of the actual health of the economy than what we see in the stock market. That's just a thought that occurred to me. As far as duration goes, if I'm holding something that is promising to pay a certain rate, and the longer I hold that thing, it's promising to pay a certain rate. If rates change drastically, that thing I hold can either be much more valuable or much less valuable if, it's a big differentiation from what the current rate offering is. So if I've got an IOU that says I'll pay you $10,000, and the payment on that is, $500 a year for the next 10 years. And then the next version comes out and it's a big deviation. I might have to sell mine at a deep, deep discount in order to have anybody interested in buying it. Cause it's like, why would I want to buy that? The newer versions are way less expensive. I don't want to have to hold yours for 10 or 20 or 30 years. And that's why we see this duration conversation really matter when it comes to the bond market. And you were going to mention this slide here, Scott.
Yeah. So this next slide, Paul, shows a shorter duration bond. So we just looked at a 25-year duration bond. This shows a 10-year duration bond. So the 25-year duration bond has fallen almost 18%. The 10-year duration bond has almost fallen 4%. So much more modest as far as the volatility there. And the only thing different is the duration. This one has a 15-year shorter maturity. And by virtue of that, the price volatility has been a lot less. So where the rubber meets the road for investors here is right now with some of the rate volatility and rate expectations kind of being up in the air right now. We favor owning shorter duration bonds right now because you're not getting compensated enough for those longer term bonds for the additional risk that you're taking. Now, there's some
Yes.
exceptions if you're using it for hedging purposes, long-term stuff. But, typically speaking, we favor shorter duration bonds. So I want to talk about how the bond market, Paul, is kind of revealing where investors' risk behavior is. And if you can go to that next slide, I think this is revealing. So I don't think we've spoken about this specific chart before with our audience, but this is what's called the OAS spread. So it's the option adjusted spread on corporate bonds in this instance. So it's a fancy way of saying this is how much more interest you're getting by owning corporate bonds rather than U.S. Treasury bonds. So U.S. Treasury bonds, no credit risk. If you own a corporate bond, there's risk that company could go bankrupt. And so they need to compensate you with a higher interest rate. So if there's high spreads here, what that typically means is investors are pretty risk averse. They're saying, hey, if I'm going to own something that's not super safe, you better compensate me to the hilt with what you're giving me. On the other hand, if they're just demanding very minimal margins, that's saying investors are pretty cavalier and pretty willing to take on risk right now. And right now, the spread is pretty low by historic standards. It's only 0.75%, meaning if you own corporate debt instead of U.S. debt, you're only getting 0.75% more for the additional risk you're taking. And I think we see this being revealed in stock market behavior, bond market behavior, where investors just shake off bad news like water off their backs. We've seen high inflation data. We've seen war and conflict data. We've seen a variety of data points that haven't been super rosy, but markets continue to march onward and upward. And the bond market is kind of corroborating this with what we're seeing right here. And we've talked about previously, Paul, that markets tend to be somewhat manic. They get over optimistic on the upside. They get too pessimistic on the downside. It does feel like we're seeing a bit of maybe over optimism on the upside.
That's really interesting. So, and then how does that play into the overall U.S. dollar today?
Yeah, so the dollar's been interesting. With the war and the global conflict, we have seen the U.S. dollar go up a little bit as far as that goes. That is kind of a deviation, though, from the long-term trend. If we look at the last 3 years, the U.S. dollar's fallen by about 4 percentage points. For much of last year, the U.S. dollar fell. And this seems to be a theme that we'll see continue to happen over time, where we're seeing other countries kind of push to have other currencies act as in a reserve status. Our own government, has kind of mentioned they'd like to have the U.S. dollar a little bit lower for trade purposes. And so we think that trend will continue. And to bring things full circle here, Paul, I think the confluence of debt, demographics, some distrust in government, depreciating currencies, all of those things have created a pretty fertile environment for things like crypto to come into vogue. And the reason being is people are looking for alternative stores of value. If there's not a ton of confidence in traditional currencies, what else is out there? There's gold out there. We've seen a spike in gold, but what other means of exchange do we have? And that led to, I think in part to the development of these cryptocurrencies. We have the two top ones listed here, both Bitcoin and Ethereum. And you can see over time, the returns on these have just been staggering. And this, kind of brings into focus, Paul, those overnight millionaire stories that we've seen when you have an asset go up as much as these have over time. And if someone has kind of the fortitude to ride out the rough times, we've seen, some wealth creation on the back of this.
Yes. Yeah. No. That's an interesting, journey to kind of get to why crypto is so relevant today. And I love the notion that in a vacuum, we have the void of like, where are people finding that store of value today? Gold obviously has been the benefactor of that void. And a lot of people look at gold and say, well, it's simply, not only is it a store of value, but it's this, precious metal that is an insurance policy, right? It's got intrinsic value. It's an insurance policy. And that may be true as well, but I actually think that what's driven a lot of the price, movement on gold is exactly this, environment you just described. And that's kind of carrying into these other asset classes like crypto. Before we get too far into the prominent cryptos like Ethereum and Bitcoin, I wanted to pause just for a minute. I think a lot of people, Scott, don't all appreciate or understand kind of the fundamentals of what is cryptocurrency and how it's built on the back of this concept, this technology we call blockchain technology. And so I want to kind of maybe spend just a minute talking about what that is like from a fundamental perspective. So if you'll indulge me, Scott and our AWA audience, a bad analogy, if you will, is imagine hiring a contractor to remodel your kitchen. And then, one of the big fears that people have anytime they go into a relationship with a contractor and a big project like a kitchen remodel or a home remodel is I want to make sure that, we understand the project scope, that there's no confusion between what you think needs to happen, what I think needs to happen, that the price doesn't get changed on us partway through the project, that the expectations, that the goalposts don't get moved. And so people say, how do we make this transaction as clean and easy and understandable as possible so we don't have any conflicts down the road where you don't feel like I, did anything wrong or inappropriate with you, and I don't feel like you did anything wrong or inappropriate with me. So let's say we fix a cost, we call it $40,000 to remodel the kitchen. And then let's say we identify key payments need to happen in stages based on reaching certain milestones. And when we complete certain parts of that project, I'll get an invoice and we'll document the milestone, we'll document the invoice, we'll document payment. But now imagine that instead of just you and the contractor keeping those records, the whole project runs through kind of a shared digital ledger. It can be some kind of shared document that everyone has access to. And then let's actually take that access to that ledger and let's broaden it. And let's say the contractor can see it, you can see it, your designer who helped build the kitchen model, they can see it. Maybe the contractor's suppliers where he's getting product from, he can see it. Let's imagine bank accounts, both the contractor's bank, my bank, they can see it. Even our accountants are involved in being able to see this digital ledger. And we'll call this, this digital ledger and all these people involved, a kitchen project network. And every time a contractor submits an invoice for, reaching one of these milestones that we agreed upon, countertops or cabinetry or whatever it was that we were working towards, then that invoice is viewed by all the parties that are part of this kitchen project network. And everybody has to independently sign off that they see the project, that they reached the milestone, that the invoice was accurate, and that the invoice was paid. And when all parties sign off on that, then we know that the work was actually completed. We know the invoice was correct. We know the payment was sent and received. And that, acknowledgement by all different parties gets logged in a permanent, uneditable file where it is, you can no longer go back and say, okay, there's 6 different people that have all logged this. We know it's permanent. We know it's uneditable. We know it's been verified independently by all these different individuals. And if there ever is an agreement 6 months after the fact that says, hey, I don't think you ever paid me for the countertops, we don't have to really argue that point because we know that it was independently verified by all the people involved in our kitchen project network. So I know that was kind of a silly analogy, Scott, but I think that's one that, helps understand or explain better the concept of blockchain technology, right? And then where it kind of weaves into this digital currency is someone invented a limited supply of Bitcoin, 21 million Bitcoin, that they said, hey, we're gonna say you've got 21 million of these. They're once they're gone, they're gone. And every transaction that takes place is going to be documented in a permanent, uneditable ledger that all parties involved in this network have to sign off on independently. So once it's been logged, it's logged and it can never be altered. And so I think there's a lot of it's very attractive, this idea of it's saying, hey, because it's uneditable and it's a permanent log, there's probably some value here. And because we've now tried to turn it into this digital currency, there's a very attractive concept here. And it started out as, a novel concept, right? People thought, oh, Bitcoin, what is that all about? I mean, there was an old story back in the day of somebody who tried to buy a pizza using Bitcoin, and it was, some 20,000 Bitcoin to buy a pizza or something like that. because it was like they're trying to demonstrate that Bitcoin could actually be used as a digital currency. And today that pizza would be worth, I can't remember how many billions of dollars, but it was, some crazy billion with a B dollars to demonstrate, that pizza. So that's kind of the concept. Now, to your point, Scott, earlier, you mentioned the two primary cryptos that we see today are Bitcoin and Ethereum. And I think you kind of talked about this slide already here, but we see the price valuation changes between Bitcoin and Ethereum. Why are these two kind of the dominating the leaders in this space today?
Yeah, so Bitcoin's interesting because it was the original, right? And by virtue of the original, it's had a lot of staying power, and also the fixed amount has kind of lent to that. So the combination of being novel and kind of first to market, and then the other piece of having a fixed amount. This is, Bitcoin sometimes referred to as digital gold, because this is like gold where there's a finite amount, and no one's making any more gold per se. No one's making any more Bitcoin, and because of that, it has kind of that anchor status. Ethereum's a little bit different. It was later to market, but Ethereum, from my research, was one of the first to have a more viable kind of exchange function, where as far as like a network to be able to transact, it had a broader network. And the advent of something called stable coins has been, a lot of that's been done on the Ethereum network. And so that's where Ethereum has come into play. But as we talk about these, maybe just to add to what you talked about with your analogy, which I like a lot, Paul, is the notion that the currency itself and blockchain are two discrete and different things. And sometimes people conflate those, where the blockchain technology can be used for cryptocurrencies, but it can be used in any sphere where immutable record keeping is super important. And you can have a scenario where the technology is viable and broadly adopted, but the currency attached to it might not necessarily appreciate in kind, because they're two separate and distinct things.
And I think that's like a possible outcome here in the future, where we all kind of say, hey, crypto is a really cool idea, but one of the things that attracts, the broad masses to crypto is this idea of a deregulated currency opportunity. And I don't think governments are all that keen on that notion. In the long run, I wonder how sustainable that idea is. And if it's not sustainable and it becomes a regulated, currency, governments come in and say, hey, we have to control it. I wonder if there is even a long-term application for digital currency, but the blockchain concept itself, you could utilize that in multiple applications that could have long-term staying power.
Yeah.
So,
and I was going to say, we're seeing that already. The securities industry is adopting that for, record keeping in some instances. Think about medical records, just anything where you need immutable record of, custody or anything else. It's a great tool.
Yeah. So, and that might lend itself to some of the volatility that we see. I mean, we see crypto prices swing dramatically. Even in this slide we're looking at right now, they can swing dramatically in a very short period of time. There's this idea, we read about this crypto winter. Scott, talk to me about what crypto winter means.
Yeah, so crypto throughout its life has had periods of time where it's kind of boom or bust, and it's very much a 3 steps forward, 2 steps back kind of scenario, where throughout its life it's had periods where it pulls back. And we're not talking a 10% pullback or a 20% pullback. It can fall 50%, it can fall 30%. And this has been the nature of crypto since its inception. And we're somewhere in that cycle right now. We've seen a pretty precipitous decline where we're off the lows, but we saw crypto down 30-40% at its lows in February, and it's still down over the past 12 months or so, fairly substantially. And so we're in the thick of it right now. We might be emerging out of it a little. But some prognosticators have wondered, hey, is it a little bit different this time? Is this something that's going to be more prolonged, or is this just a bump in the road in an otherwise ongoing rise onward and upward for crypto?
Yeah. So what do you think investors maybe misunderstand most about the risk associated with cryptocurrency?
I'll answer this, Paul, by, kind of going back to your comments where we tend to see pretty extreme views as far as crypto, where we see, perhaps some takes that say, hey, this is, economic salvation for monetary systems, and, very, extreme views as far as that goes. And others where it's, hey, to your point earlier, this is, a farce, and it's speculative, and it's a waste of time. And I think the truth is probably somewhere in between those two extremes, where there is enough interest and these currencies have been mainstreamed enough where I think they're probably with us to stay to a large degree. We look at some of the legislation out there. There's the Genius Act, which was passed. There's the Clarity Act, which is likely to be passed. And there's explicit government endorsement of cryptocurrencies. And so, one might take that and kind of go all in, but I would caution that as well, because at the end of the day, there's still something called fiat currency. There's no underlying earnings backing these, Paul. There's not any underlying asset like gold, but backing these. These are solely predicated on trust. And if that trust ever erodes in a material way for any one reason, we could see these fall significantly in value. So while they are becoming much more mainstream, they still carry a ton of speculative risk that people should be aware of.
I love that. So let's take that idea and let's shift forward towards portfolio construction and investing, because at some point, if crypto does kind of cement itself as a legitimate asset class, if we all kind of say, okay, there's enough trust and there's enough mainstream concept here and there's enough application here that it's not just speculation, it's not just this fiat currency, there's a legitimate application here, it's an asset class now. How does it, where does it belong in an investment portfolio?
Yeah, no, it's a great question, Paul. And I think with the advent of kind of some cryptocurrency ETFs, I think there is some of that adoption that's happening. But I do think prudent investors are very measured in how much they put in their portfolios. And we are talking very small amounts, because they can be disruptive significantly. I mean, imagine if one had a significant portion of their portfolio in cryptocurrency and just endured a 30 to 40% drop. That illustrates why you don't want to have those weightings too large. But if small nominal amounts on the margins are added to crypto, that can potentially add some benefit. We look at things as we put together portfolios called correlations. We look at the different components of the portfolio and how well they track together. And if we look at this chart right here, anything that's deeply red means it tracks very in line with each other. Anything that's green means they actually move in the opposite direction. And so we have a variety of assets on this chart. We have some growth stocks, some value stocks, some bonds. We have gold. We have Bitcoin and Ethereum. And if you look at the two bottom rows with Bitcoin and Ethereum respectively, we can see lower degrees of correlation there. Now, some of that can be attributed to the recent drop, but having some assets in your portfolio that don't move necessarily in lockstep with everything else in your portfolio can provide some additional diversification benefits. And so if one can be super disciplined with it and not get out over their skis by owning too much, on paper, it could add some better, what we call risk-adjusted returns to your portfolio, provided you're very careful with the amount you put in the portfolio.
Yeah, I love that. I think the again, I like to borrow bad analogies, but I think the analogy I use when I explain this to clients is, when you're putting together, when you're making a cake, there's going to be all sorts of ingredients that if you're not a baker, you might not appreciate that ingredient belongs inside of the cake recipe. For example, baking soda or baking powder. You look at that, you think, okay, that tastes terrible. I put a little of that on my tongue, and it's like, why on earth would that ever go inside of a cake? That's a terrible ingredient. And a cake should be delicious and sweet. And why would you ever do that? But the baker knows it's a component of a bigger, kind of orchestrated event that we're doing. And it ultimately makes the cake a better experience when you include that. Now, you can overdo it. You can put a lot of baking powder in a cake and it's going to make it terrible. And then you might have to overcompensate with adding more and more and more sugar to the cake to try to offset some of that bad flavor. And then you end up with a really poorly built cake that not only tastes funny, but it's, it's lost all of its nutritional value. Not that a cake ever started with any, but it's really a bad outcome. And that's part of this portfolio construction concept, that adding some of that, kind of crypto in the right proportions can actually really add to the value of this correlation matrix and offsetting some of the zigging and zagging of the different asset classes that go into a portfolio.
Yeah, no, I like that a lot, Paul. And I think that hits the nail on the head where, this can be something, if properly, applied, can be additive to the portfolio, but boy, you miss by much on it, and you can ruin the portfolio if you're not careful.
Yeah. And I think we all see, we've all heard the stories of, the guy who has the $10 million house up on the mountain, and everybody goes, yeah, he hit it big on Bitcoin. Right. And I think there's something that's very like mysterious in the allure of like, it's almost, it's really, in my mind, it's almost like winning the lottery though. This is like, you can't go all in on something like that, because every time you hear that story, you've got 1,000 other versions of that story where, somebody went all in on something and they lost it all. And so one of the, themes of portfolio construction is being very intentional, and not making those, speculative risks, because at the end of the day, this is the money that's going to determine your retirement lifestyle. And there's just no room for making those kind of speculative risks. So does it belong as a component? Sure, it absolutely can, in the right proportion. Is it something that needs to dominate the portfolio? I'd be very, very cautious about anything like that.
Agreed.
So Scott, let's bring it all together. When you step back and look at cryptocurrency as a whole, what's the biggest takeaway for investors right now?
I think probably the biggest takeaway is, I think it's, again, been institutionalized enough where it's likely here to stay in some form or another. It's a certainty, and it's a given that blockchain technology will be here to stay. And I think by extension, I think cryptocurrency in some way, shape, or form will be here to stay. But this is far from a settled environment. Countries are developing their own digital currencies. To your earlier point, where legislation goes in different countries will be anybody's guess. And so this is still a very fluid space. So look alive, kind of have your head on a swivel a little bit as you navigate this space. But I think those are the big takeaways, that it's probably, here to stay with us. But, there's a degree of caution and wisdom that probably needs to be exercised.
That's excellent advice. And if you're feeling overwhelmed or confused by cryptocurrencies, reach out to your team here at Alliance Wealth Advisors. We spend the time and energy to understand these concepts, where they have appropriate applications in any retirement portfolio. We can explain this to you, walk you through it. If there's an appetite that goes beyond what exists inside of our current models, which we believe is an appropriate proportion to a good retirement model. But if there's an appetite beyond that, reach out to us and we'll walk you through, what we can do to help in that space. In addition to, an appropriately balanced portfolio. Scott, I think that's all we've got time for today. As always, thank you for helping us simplify these complicated topics and bringing perspective to our clients in, these fast moving in markets. And to all of those who have joined us today for this month's Market Minute, thank you for being a part of these market calls every month. And until next time, thank you, everybody.
Thanks, everyone.